So good morning, everyone, and welcome to the PortGen training on indirect cost and fully burdened rates. It's good to see such a robust group of people on the line here. My name is Tiffany Scroggs, and I'll be helping facilitate today's training along with one of our expert speakers, Robin Clark, who we will introduce here shortly. I'm going to go ahead and kick us off to the next slide here. So we'll do introductions. We kind of already did that. We will talk about why we're here for professional service providers, talking about the importance of being able to support your rates and what that looks like. We'll talk high level, whether or not your accounting system is good to go, and then we'll provide some final tips and resources. So go ahead and do next slide here. So coming in soon is Robin Clark, who is our CPA here today that helped kind of frame this presentation. So we'll introduce her formally here in a minute. So what would help us understand a little bit more is if you can find the chat. This is going to be an interactive training. So if you have your email up or you're driving your kids to school or something like that, please kind of pull over and enter in the chat your confidence level with your rate. And we promise we won't judge you on this at all, but we want to know 5 being, I got my rate, I know what it is, and I know how to use it. And 1 being, what rate? What are you talking about? So, and I'm talking indirect cost rate or fully burdened rate, you pick your choice. But 5 being, I got this dialed in, I'm just here to triple check I got it right. Or 1 being, I have no idea what I'm doing. Oh, good. Okay, thank you for that. Wonderful. Okay, so we got a good mix of 2.5. We got some 3s. We got a 1. Yay! I love the 1s. Welcome 1s. Who's our indirect cost rate expert? They should be. Oh, was it Aaron? You're level 4. Very good. I think you're giving yourself not enough credit for that.
Well, you use the word expert. I didn't, but okay.
All right, good. All right. And I see that Robin Clark has joined us today. Robin, can you hear us okay?
Good morning.
Hey.
I have no idea. I cannot explain why I couldn't get in and why this couldn't have happened in a test run.
Right. Yep.
Instead of the final.
That's okay. So we're getting a feel for the audience today. We have a good mix of service providers and construction companies that have a variable understanding of their rates. On the line right now, let me go back, is Robin Clark. Robin is a retired certified accounting professional, a CPA. She worked for most of her career for the Defense Contract Audit Agency. She also was a consultant for the Department of Transportation at the state of Washington. She's very generous with her time, and I've seen her train before, and she's fantastic, helping kind of simplify what can be complicated and overwhelming if numbers aren't your thing. So I'm delighted to have Robin here today. We're going to get to a couple of slides first. I wanted to kind of walk through that in contracting at the port and at other places like WashDOT, the service providers have labor as their major cost element. So unlike maybe construction where there's a lot more supplies or something like that, or manufacturing for sure. And in the evaluation factor, which is where Apex can kind of be helpful, is helping you understand that the non-cost factors are going to be the most important thing for you to win these contracts. It's going to be your expertise, your key personnel, your qualifications. And so it's not necessarily price like it is in construction. It's going to be all those other non-cost factors. However, you could really get yourself in trouble by bidding and winning this stuff based on how smart and wonderful you are. And then later go to negotiate your rate and lose your shirt performing. And we've seen it and we hate it. And we want you to be successful sustainably, long-term in the marketplace, which is why we're holding this training today. So the last bullet there, if you can't explain your rates, you can't bid correctly, and you'll struggle to justify them when you go into those negotiations. So that's kind of our opening slide here of why we're here and why these rates are so important. 2 more slides, I think, before I turn it over to Robin. In in the port contracting, and there's an event coming up at the end of the month that will explain this in much more detail. They have two types of service agreements. The first one is that professional consulting, and the second one is personal consulting. And in professional consulting, like your architects, your engineers, look at that. It says consultants are selected based on their competence and qualifications, and price cannot be a selection criteria. So the port has to find another way to ensure that your price is reasonable. And that's what we're going to talk about today. When you get a contract, there's going to be two different types, and you want to be aware of the two different types so that you can be sure that you're handling it correctly. There's what's called IDIQ, so indefinite delivery, indefinite quantity. We don't know how much we want, we just know we want it type of thing. And then there's the project specific contracts that are going to be more likely to be lump sum. So that IDIQ contract is going to be based on a specific scope of work and level of effort with an hourly rate payment. So once again, it's really important that you understand for both of these, your rates and how they impact your profit and your ability to sustain your business long-term in the marketplace. So here we are with our port sourcing process. And I pulled this slide directly from the port. You know, it first starts off with you registering to sell to the agency. You find something to bid, you attend the pre-proposal conference, you submit your proposal, you get interviewed, maybe if it's applicable, you get notified that you are the selected business, and then you go into negotiations. So that second to last bullet is where you go into pricing negotiations for your company. And that's going to be where you kind of outline your cost, your rates, and they assess the reasonableness based on their own internal benchmarks. So this is oh, it looks quite blurry on my screen here. But this is the negotiation process. So the port issues that notice of selection, then the negotiations start. And this is just a screenshot of the actual process, which is much more complicated than to put on a screen here. But essentially you go back and forth up to 3 times with the port. And if you can't find if you can't agree on appropriate rates at the end of the 2 or 3 back and forth negotiations, then they're going to move on to the next bidder. So it doesn't go on forever. It's very defined. There's days, timelines that you have to meet. And if you miss those deadlines, you're at risk of losing the contract altogether. So now I'm going to turn it over to Robin, who's been chomping at the bit to get in here. Robin, please, let's talk a little bit about supporting your rates. Go ahead.
Okay. And supporting your rates in a situation where labor is really a major cost of the proposal. That's what we will be talking about. Your proposal will consist of a fully burdened labor rate. And that means that it will have all the direct costs, all of the indirect costs, and your profit in the one rate. And because labor is the dominant factor, it's dollars per hour. So today's presentation looks at ways to look at the costs in a proposal and make sure that you get paid each cost once and only once. If some costs are not reimbursed, you will lose money and lower your profit. If you set up your accounting system in such a way that the same cost is both direct and indirect, you can wind up being reimbursed more than once for your costs. And that is never allowable. And if your accounting system is to be believed, that is something you want to avoid. So one way hurts you, by lowering your money. The other way hurt you by making it very hard for you to get a contract. Okay.
Great. Next slide.
And okay, so let's start with the direct cost piece. These can often be traced to the request for proposal. That's why they're considered direct. They are necessary for the proposal. If the proposal is, for example, for a drawing, an architectural drawing, it would be important that you include qualified labor to do that. That is necessary to deliver it. If your accounting system allows, you could also put, if there is something unique in the proposal that has to be delivered, you can put that in as direct costs. And normally, whatever the direct costs are part of your company's expertise. Okay. And so then we go on to the second part, which is indirect costs / overhead. Indirect costs is anything not direct labor that is allowable. For instance, vacation for the employees, whether it is the president of the company, the person who is doing the work on this contract, or the receptionist. Those are all indirect. Rent and utilities, likewise, are necessary. There has to be a place for the company to be located, and that place needs to be heated and livable. Marketing, some limited marketing to the government is allowable. Now, this needs to be separated out from, let's say you decide to give balloons to every child in the neighborhood for Easter. That would not be considered marketing per the contract. Marketing might be going in a meeting like today, where you're learning something, or it might be you conducting a meeting for various people that might want your service, but it has to be service related. Supervision and insurance and those types of costs are overhead. Overhead on the port's import form also includes profit. This may or may not be true on different proposals, but in the input form, it is part of the fully burdened overhead rate. And profit is often discussed in the RFP. It may or may not be in what you're looking. I have seen everything from something saying you can have a 3% profit to something saying you propose your profit. There are lots of different ways to do that. You need to look at the proposal you're looking at to determine what you want to include in this proposal. Okay. Okay, so let's do a few examples of a fully burdened rate. And example one, we're going to say direct labor is $40 an hour and overhead is 10%. So that would give you $44 an hour. Why is this an example flawed? What can you see right off the bat that's missing?
And feel free to put that in the chat or just unmute and shout it out.
Okay. So first thing, the first thing that strikes me when I look at a 10% overhead rate, I know there are no fringe benefits in it, because fringe benefits run much higher. So that, you know, is not in here. There is also not profit. If we're talking about doing the input form for the port, both of those need to be in the calculation of the fully burdened rate.
That's right. I think Tina in the chat said she's worried about taxes, benefits, office space, equipment, time off, and how could that all possibly be in a 10% overhead rate?
Yes, unless it's a very small operation, it just wouldn't happen. And it probably would not be consistent with the labor rate of $40 an hour.
Emily
Okay.
has a question.
Sure.
Robin, when you said fringe benefits, you hadn't used that term earlier. Are you using that interchangeably with indirect cost rates? Are they the same?
No, I am not.
Okay.
Fringe benefits are what you grant to employees, both direct and indirect. So in essence, there would be a pool of costs, including things like vacation, payroll taxes, 401k, medical insurance, sick leave, anything that your company pays to an employee. And that would be called a pool. That's the pool of the costs. And to get the rate, you would take all of the labor of the organization. So since both direct and indirect people get fringe benefits, they are both in the base. So, you know, that's another reason why it would just not be believable that overhead would be 10%, because payroll taxes would take up a good part of it right there. And immediately, if you did not include your fringe, you would be hurting yourself and not recovering the costs you need to continue as a business.
Gotcha. So,
Right,
so
and
to
we have-
clarify, fringe benefits includes direct and indirect, but it's anything that's related related to the employees, whereas indirect cost rates might include some of the employee related fringe benefits, but might include other things in addition. Is that correct?
Yes, indeed.
Great. Okay.
Yes, indeed. Overhead, fringe benefits is just a part of overhead. It's
Thanks,
much
Robin.
more.
Robin, we had another question about the direct labor rate, the $40 an hour in this particular scenario. Does this mean just the raw cost earned per hour by the employee?
Yes, the direct labor rate is, if you were doing their paycheck and it's an hourly employee, you would say number of hours worked times how much they get for each hour. That is the direct labor rate.
Great, thank you. Let's move on to another example. See if we can get
Okay.
that.
Okay, so let's go back and let's put fringe benefits in our calculation of the fully burdened rate. We're still going to consider that the person is making $40 an hour, the person you hired to do this task required by the contract. But in addition to that, for every hour this person works, you need to recover an additional 50% to cover your costs and make sure that you are getting reimbursed what you need reimbursed. So in our example, we are using 50% to calculated rate. That does not mean I'm not recommending 50%. I'm only using it as an example. It will very much depend on what benefits your employees get. But in our example here, 50% of $40 is $20. So our fully burdened rate would be $60 an hour. 40 that goes to the person, and 20 to various sources in the organization that support the work for this contract. However, you're still not getting back what you need to keep going. Can you figure out what's still missing?
So Patricia put into the chat, profit is still missing.
Yes, yes, clearly profit, because even if you were getting the correct amount of direct labor and the correct amount of overhead, without profit, your organization is not going to be doing well. So, shall we move on? Okay, this is example 3. And we're building on our previous example. The labor rate is still $40 an hour. The overhead is still 50%, and it does include fringe. But now we are also going to add profit. Okay, so in example 2, what we would have proposed would have been $60 an hour, 40 labor, 20 overhead. But now we need not only that $60 an hour, but we have to add to that the profit percentage times the $60. And the reason we are not suggesting a profit percentage, because that is handled many different ways by many different places. And that is why we are saying profit at X%. So you'd want the 60 you had before and add X% of 60 to it. And that would be the number that you would put for your fully burdened overhead rate on the input form.
All right, so what questions do you have? Okay, I think we're feeling good. Thank you for simplifying that. We're going to talk a little bit more about direct versus indirect, because this is something that trips up a lot of businesses. And like we said at the beginning, if you count a cost as both direct and indirect, you're committing one of the biggest no-nos in all of accounting. And so we can't do that. So we got to categorize costs as direct or indirect. So we have a little pop quiz here. We need you to name a cost, and then this group will determine if it's direct or indirect based on our earlier definition. So hopefully you were paying attention. So who wants to throw a cost at Robin? She can talk about whether it's direct or indirect. Name a cost. Management.
Okay, I saw them sort of fast. So let's start out. Management, yes, is indirect. So that goes in your overhead pool. I saw B&O. I saw that one go really fast. B&O tax is indirect, particularly if you're using the B&O tax from Washington, because it does not depend on profit. It is a tax that you pay for being in business in Washington. Now, different states have different business taxes, but in Washington, that would be indirect, and it is determined, again, based on the whole composition of the company's costs.
What about office space rent?
Office, what'd you say?
Office space.
Oh, office space, unless you find it mentioned directly in the RFP, it would be indirect. Now, this is one to talk about a little bit, because the normal company experience would be that occupancy would be an overhead pool that includes all of the costs of where the people are doing business. Now, if the contract says we need to do some testing, and for this, you are going to have to rent a 10 by 10 foot place that is totally free from any utilities. They tell you have to have a space, and this is what the space requires. That is making it a direct cost. You have to look at a direct cost and be able to trace it to the proposal.
All right, Robin, what about employee parking at the work site?
Well, now that's, I know, I normally, yeah, that would be indirect. Now, it is potentially possible, if you don't treat employees alike. Let's say the president gets to park his car and it comes back washed and fully fueled. That would be unallowable. But normally, I would consider that a fringe benefit. I think that would be the normal consideration.
Great, but you could see an opportunity for the business to make the case that if a particular engineer is driving to the job site, paying the $40 an hour to park, that could be directly related to the contract?
Only if that engineer does not normally drive to the site first thing.
Okay.
It would have to be a different practice.
Okay, good. So that's a wonderful kind of segue into this concept of there are some guidance that can, correct me if I'm wrong, there's some guidance that can help you determine what would typically be indirect or direct. And you want to just make sure that you're kind of consistent and in line with kind of those general principles. Is that a good way to frame it, Robin?
Yes, I would add one additional thing to it. It is always extremely helpful if somewhere in your accounting department, you actually have a manual, a policy, a memo, whatever, saying what you consider a cost to be, so that you could switch accountants and still get the same cost in the same place.
Beautiful. All right, we have a couple more examples, then we have to move on. Equipment.
And again, equipment is one of those that can be direct or indirect. If it goes to the RFP, if it's something that is required to produce what is being asked for, it is direct. If you have a forklift, just because you have so many boxes of records in a storage area, that is not direct. That would most likely be considered part of your occupancy pool. But, you know, again, to be direct, look to the contract.
Okay. Last one, bid and proposal time worked on getting a project, direct or indirect.
Okay, so let me say a little bit about this. If you are a very large firm, you will have a whole separate pool of bid and proposal costs. And so that will be an indirect pool. I would not expect any beginning contractor or a contractor with a small number of contracts to do that. So you normally, the cost to bid the contract would be indirect. However, you may find in the RFP that they specifically say costs of bidding the proposal are not going to be reimbursed. That supports the fact that they are indirect.
Great.
So, and I'm trying to think if I've seen them direct. I think probably the only time I've seen them direct is if the RFP contains provisions to reimburse those costs. Very seldom seen.
Okay. All right, let's, one thing we hear a lot is program managers or outreach specialists at like WashDOT or wherever saying you need a FAR compliant accounting system, or you need your FAR rate. And what they're referring to there is the federal acquisition regulations and the role that federal funds have on contracting, even if it's through the port or through the State Department of Transportation office or something like that. So Robin, can you talk a little bit about the role of federal funds and how it influences all of this?
Okay, so if federal funds are involved, normally the need to follow FAR goes down to subcontractors. So even if you don't hold the primary contract, but you have a contract to one of the primary contracts subcontractor, they're still going to ask you to use an accounting system that has general ledger control. And that means there has to be a general ledger that separates costs by contract. And that would mean if you get a contract, you have to open an accounting category for that contract, one or more depending on the contract. And the accounting system has to allocate indirect costs to a contract using a causal and beneficial base. Now, what that means is normally you don't really know on all indirect costs exactly when and how they're going to be incurred. But between the pool of indirect costs and the base, there needs to be a causal beneficial base. And for instance, fringe benefits is a good example of this. The reason that you allocate indirect costs for fringe benefits over labor means if you did not have that employee, you would not have those costs. So, and the last thing that FAR says is your accounting system has to identify unallowable costs and keep them out of government billings. And that means, let me give you an example. You may be very happy that you got a contract, and you may throw a little party to celebrate it in the company, and you may serve champagne and you have a little entertainment. That would be unallowable. So your accounting system has to have some place where you put those types of costs, and you do not let those costs go to government billings.
And we have another slide on that, Robin. There, a question came up about how often FAR comes up with the Port of Seattle contracts. And we did reach out to the one of the rate negotiators at the port, who indicated that he didn't say how often it happens, but if there is federally funded dollars helping pay for the project, that'll be clearly articulated in the solicitation and the contract documents. But I don't know, Emily, if you know how often that does happen. I don't know.
Yeah, I'll chime in real quick. so most of our projects are locally funded. I would say maybe the majority. There are projects obviously that do receive federal funding. And I've also sent this question over to Jason to see if he has any thoughts on that, but that's the context that I've got.
Great. Thanks. We have 15 minutes left. Let's continue on.
Okay, so a question that I very often have heard over the years is, can you use QuickBooks? And yes, you can use QuickBooks. QuickBooks can satisfy all of the requirements of FAR. However, the accounting records generated by QuickBooks are only as good as the person who sets up the chart of accounts. And it is a crucial step. And I can often tell you that I can go in and look at accounting records that have been generated in QuickBooks, and I will see, for example, that the state of Washington owes taxes to the organization. That tells me there's a problem, because the state of Washington does not pay taxes to organization, it collects them. And so look, even if you don't know QuickBooks and you get something, look for things. For instance, if direct labor is owed, probably fringe benefits may be owed. So look for just some of these little clues that if you expect one thing, you expect to see another. And the allocation of indirect costs to the contract can be done by separate journal entry as long as there is sufficient support. So you do not need a complicated accounting system that does your allocations for you. They can be done on an Excel spreadsheet. Look at all the data. And then you make a journal entry with what you've covered on your Excel spreadsheet. And that will be correct. Okay, now, FAR 31, Section 205 discusses indirect costs, and many of the costs that are discussed that in FAR Part 31, Section 205 have often come from court cases. Either they've come up a lot or they've come up from court cases. There is a change being made at this point in Section 205 of the FAR. Before change can be made, there will be notice and/or discussion in the Federal Register. I looked at the latest, as of the beginning of October, of the Section 205 revisions, and virtually every one of them involves definitions, and I only saw one cost. It used to be that if an executive in your company drove their business car, home at night, back to work, that was unallowable. That has been removed. There may be other changes that will occur but I have not seen it yet.
Okay. Great, thank you. Let's talk more about allowable, unallowable, and then we'll get to questions at the end. So we have 8 more minutes. Robin, if you could breeze through these 2 examples, just 2 quick examples.
Okay, you want my suggestion? Number 1 is not an allowable cost.
Oh, come on, it's a
sort
morale
of like,
boost.
it's sort of like having alcohol at a wind party. I mean, it's nice, you may want to do it, but you sure do not want to charge the government for it, the federal government for it, or anybody who is using FAR.
All righty. What about a purchase membership into like the Association of Civil Engineers or whatever?
That is allowable. The government wants all of the people who work on government contracts to be up to speed and to be knowledgeable in their field. So this is an expense that the government considers allowable.
Great, thank you. So in the slide deck that you received, there's some tips and some links to more resources. I know a lot of you, if you're doing business at the port, you're probably also eligible and interested in doing business with WashDOT or Sound Transit or one of the other agencies here in the Pacific Northwest, and they all do things slightly differently. WashDOT, for example, has a safe harbor program where if you don't have an approved indirect cost rate, you can just use theirs for up to 3 years, and then they kick you off and want you to swim on your own. When you're in those programs and you're using like the safe harbor rate, you should still know what your actual rate would be if you were not in that program, because it'll allow you to know if you're missing out or if it's a good thing for you, good or bad, right? So we didn't have time in this hour to kind of help you set your rate, but hopefully we gave you kind of a high level understanding of what to look for, and so that when you go to your bookkeeper and your accountant to finalize your rates, you understand what it is they're doing. And if your accountant won't take the time to teach you what they're doing and to help you understand the decisions you make in your business and how that impacts your rate, you need a new accountant. So Robin, what other do you want to add to these final tips and resources?
Okay, FAR 31 talks about the federal acquisition regulations regarding costs. And many of the things discussed in FAR 31, you probably wouldn't even consider having or doing. But it could be interesting to see. And if you have a question, 205 discuss the costs that are often disagreed with, and it'll tell you just a little bit. The next one, DCAA toolkit. DCAA, although you probably won't meet them in this context, but they do have a pamphlet called Information for Contractors. It's free, and it gives you some examples and some feeling for how DCAA will look at your rates. And then the port, should Emily talk about that?
Yeah, I'll just chime in here. The port has a service agreement page that kind of outlines how they do service contracts. And that's helpful. And then the Apex Accelerator page. The other thing that's in the chat, and maybe Leslie can repost it, is a copy of that input form. And I upon reflection, I should have listed a link here so that you had it at the very end with all the other links. But this is an Excel sheet that will you'll be asked to provide after you're selected, and it kind of is the go-to starting of the negotiation. And so that's, hopefully we kind of helped frame the importance of the fully burdened rate. That's the one number they require on that form. Okay, upcoming events, and then we'll go to your questions. There is a Positioning Your Firm to Work at the Port event on October 15th. We'll walk through Vendor Connect and a lot of other tips and tricks. There's a PortGen 101 for service agreements coming up on October 29th, and that's virtual. And then if you happen to be in aviation or maritime maintenance or for supplies or maintenance services, like HVAC, for example, they have an event coming up October 16th. There's the North Puget Sound Contracting Conference up in Linwood. That's a big one. And then the Port of Seattle Celebration for Small Business, December 16th. Emily and her team will be talking about upcoming port contracts. A lot of the primes will be there. It'll be an excellent opportunity for networking. So what questions do you have for Robin? I think I saw one up here. If I'm a business owner, what is the best way to come up with an appropriate rate and appropriate profit rate?
Okay, the best way to come up with an appropriate rate would be, one, to look at your accounting records for the last full year, and then look at your accounting records for the year to date of this year and see which costs are indirect, which are direct, compute your rate, look at each of your cost categories, make sure that you are not including unallowables, and compute the two rates, and hopefully they're close. If they are not close, look at them. Look at them and see, is there one that's going up? Now, maybe labor's going up, and you know that because it is going up in your industry. So that would say the last year full rates would not, it would be better to use an updated labor rate. It is better, rates are computed on an annual basis. And so it is better if last year's rates look the same as this year's rates, but that does not always happen. So there you need to look at each and every cost element.
Great, thank you, Robin. And Leslie Miller put her direct contact in the email there. We didn't introduce Leslie as being a accountant, but she is, and she knows a little bit about this kind of thing. So Leslie Miller on the Apex team can also help you get oriented and introduce you to the supportive services that are out and about around the state too. If you absolutely cannot hire your own CPA, but you feel like you need to, reach out to Tabor 100 or Business Impact Northwest, or Apex will get you that warm referral and see if they have any resources for you to help get you started. But having a strong accountant and a bookkeeper on your team that can help you navigate this is absolutely essential. And if you're not getting the information and being able to have that conversation about how your rates are impacting your profitability, then something's going on and you need to shop around for a new one. So Robin, I want to thank you for sharing your wisdom and time with us today. You're a wealth of knowledge, and you did a nice job helping simplify those fully burdened rates for the team here today. Thank you to Emily for hosting today's event, and we wish you well. And we'll stay on for other questions, but we'll go ahead and end the session for now. Thank you.